also should be taken it to the present value. After 20 years, if you have to dismantle it, bring that cost also into the present value, and that is also part of your initial cost. Even though you are not going to incur today, even though you are not going to pay today, after 20 years, if you have to dismantle the building, and all that cost, the present cost should be brought in as cost. You can use two models to reflect it in the financial statements. One is what we call the cost model. The other one is what we call the revaluation model. If it is cost model, it is always carried at cost less accumulated depreciation less any impairment losses. Cost minus accumulated depreciation minus any impairment losses. If you are using the revaluation model, it will be carried at revalued amount minus accumulated depreciation minus impairment losses. So if you are going to do revaluation, it must be periodically revalued, keeping it up to date, consistent policy for each class of assets. I mean, what they say is you can't do cherry picking. You can't particular one land you can't do revaluation, the other land you can't do cost model. The particular class of assets all must have the same accounting treatment. Revaluation should be at the open market price, what we call the fair value. So it is not the value in use, it is the value that is in the market that should be the revalued figure. Depreciate the revalued asset at the amount less residual value over the remaining useful life period. I just want to look at that particular last sentence what I said. Now you might take asset today. After some time, it is all depreciated partly, and suddenly you decide to revalue it and bring it to the new value. So I just want you to take a little bit of a piece of paper, Fiona.
Yes.
And write one little thing. I'm going to put a small question. I was trying to put the question on the screen, but I can't do it. But it's a small question, but just put it up. You say P bought an item of property, plant and equipment.
Yeah.
P bought an item of property, plant and equipment for 80 million.
Yeah.
On 1st January 2012. So the important thing is the date.
Yeah.
January
was that 2012?
January 2012. It was bought for 80 million. It had zero residual value. And the estimated useful life period was 20 years.
20 years, okay.
On 1st January 2015, the assets are revalued to its fair value of 95 million.
Okay.
The examiner is asking you at what price, what is the amount that will be shown in the financial statements for the year ended 31st December 2015. That's your question. At what price or what will be the value that will be shown in the statements for the year ended 31st December 2015. So now think what are we going to do. Originally, we went on cost basis. It cost us 80 million. Residual value 0. So depreciable amount is 80 million.
Okay.
And it was to be depreciated over 20 years. So that means for a year, depreciation is 4 million. 80 divided by 20, correct?
Yeah.
4 million. So 1st January 2012 we bought it. So entire 2012 we used it. Entire 2013 we used it. Entire 2014 we used it.
So 2013 was when it was purchased. So we used it 2013, 14 and 15 it's revalued.
15 beginning it's revalued. It was bought on the 12 beginning.
Yeah. Okay.
Right. So now see how many years they have used it before the revaluation came.
Yeah. So 2 years.
2 years or 3 years? Just see. 1st
So
January
it was
2012.
12. Sorry, I
Yeah.
misheard you. I've written down 13. So
Okay.
2012.
Yeah. Yes.
So that's
2012,
so that's 3.
2013, 2014, isn't it?
Yeah. So 3 years.
3 years have gone. So what will be the accumulated depreciation for 3 years? Every year we are going to provide 4 million.
Yeah.
So 4 million into 3, 12 million will be your accumulated depreciation. Agreed?
So it'll be 68 million.
68 million will be the figure on the day that they decide to revalue it.
Yeah.
Right? 68 million. And now how much they are going to make it? 95 million. So the 68 million figure, what is appearing in the balance sheet, will now go up to 95 million on 1st of January 2015. Agree?
Yeah.
Right. So 68 and 95 million. So how much we are going to transfer it to the revaluation reserve?
27 million.
27 million we will be transferring it to the revaluation reserve. So 68 will go up to 95 and that is the amount.
Yeah. And 27,000 in the revaluation
27
reserve.
million will go to the revaluation reserve. Now what is the new figure that is appearing on 1st January 2015? The figure that is appearing is 95 million.
Yes.
Right.
So the useful life will remain the same at a further 17 years.
Exactly. That is very good. So 95 should be divided by 17.
Yeah.
So we will have a depreciation figure, divide 95 by 17. We will have an annual depreciation figure coming out.
Yeah.
Right. So that figure, so now it is now 17 years. So the first year it will be 95 divided by 17. That will be your depreciation. That amount you will be providing as depreciation for new now. Now no more accumulated depreciation. Accumulated depreciation is gone because we have started something new. So 5.5 million will be provided as depreciation for the year.
Yes.
So it will appear at the end of 31st December 2015, 95 minus 5.5.
Yeah.
This is simply what we need to know. This is simply what we need to know. So it will be 89.5 or something like that. Figure that
Yes.
will
Yeah.
appear in the balance sheet.
Yeah.
This is a little illustration what I did. So I'm going to send you a few questions after this to you so that you will get some idea of the kind of things we are looking at. Then we looked at another standard called IAS 23. It was all about accounting for the borrowing cost, right? That is where we have what we call a qualified asset. What is a qualified asset? An asset that is going to get constructed or bought over a period of time, more than one accounting period. And for that purpose, if you borrow money, interest what you pay during the construction period or during the time that it is being constructed or been bought over, the interest cost on that borrowing can be charged to the straight away to your cost of the asset. You don't need to charge it to the finance charges. You can charge it to the cost of the borrowing to the cost of the asset.
Yes.
That is what we learned yesterday. So that is what we call a qualified asset.
Yeah.
Is what we started last time. So I just have two more slides to go on this one. it's all about the impairment of assets.
Yeah.
What is the impairment of asset and how does it happen? And what is the impairment of asset? So we discussed this one yesterday. When the carrying value of a particular asset is more than the market value of the asset, or what we call the recoverable amount, that amount should be immediately charged to the P&L according to the IAS 60. So IAS 36. So we know what is recovery amount is the higher of the net selling price or value in use. How do we calculate the value in use? We look at the present value of future cash flows discounted by using the asset. How do we calculate the net selling value? It is the at what price can we sell and how much we will get, but how much we have to incur to sell minus that one is your net selling price. So that figure, the higher of that figure between the two figure is what we call the recoverable amount. Recoverable amount is, say, shall we say 80 million. That is the higher of the net selling price or value in use. Carrying value of the asset is 85 million. 5 million need to be immediately written off to the P&L according to the IAS.
Yeah. Okay.
So at each reporting date, company should assess whether there is any indication of an impairment, and if there is any impairment, it must be written off straight away to the P&L. How do we know that there is an impairment? Right? So you have to identify possible impairments. It can be either done externally or internally. You have to do what we call an impairment review. Impairment review. If there is a possible impairment, you must do an impairment review. So, and then according to IAS 36, record the impairment. What are the indicators of impairment? So externally, you might find a significant decline in the assets market value more than expected by the normal use or passage of time. Right? A significant decline. Something has happened in the market and the market is crashing and the asset what you bought at a particular price is sharply dropping. It's not a normal drop. It's a kind of a sharply drop. These are the terms our examiner will use to signify this kind of an impairment. So whenever examiner says there's a significant decline in the assets market, more than expected by normal use or passage of time, I mean, once you use it gets decline. But here we are not looking for a normal kind of a decline. We are looking for an extraordinary decline, something more than normal. And if that kind of an indicator is there, surely that is a moment for you to go for an impairment review. A significant adverse change in the technological, economic or legal environment. For example, you are using some particular machine to produce a particular food item and the government has banned that food item from selling in the market, saying it's harmful or whatever it may be, right? At the moment it is sold, immediately there will be a kind of an impairment of the assets. You have to consider that one because it's a legal environment. It can be the economic environment. In that kind of a scenario, there is an indicator of impairment. So those are basically the external sources of indicators of impairment. What are the internal sources of indicators of impairment? It can be a physical damage to your machine. There's a physical damage which is a permanent kind of a damage and you feel it cannot be rectified. In that case, the asset's usefulness is becoming drastically reduced. Immediately it must be impaired upon. Significant changes in the period of expected, the way asset being used, asset becoming idle kind of a situation, right? Or you may be discontinuing a particular operation where the asset is used and now that asset is not having the same kind of a use. So there's a decline, right? Economic performance is much worse than what we expected. We thought it can produce particularly 100,000 units of whatever the thing what we are producing for a year, but it is only producing 70,000. So the economic usefulness of the asset is much more than worse than what we expected. That's an internal source. You have lost a key employee. There was a man who was taken to operate this particular machine. He is one of the very few people in the country who knows how to operate the machine. That fellow has left the company.
Yes.
Because the machine has lost its value. Even though the machine is same, you don't have a person to operate it. So it can't bring that economic benefit what it has to bring. At this point, just a little deviation. What is an asset, Fiona? What is asset? How do we describe asset according to our financial framework? There's a definition given for an asset.
An asset is a tangible asset would be like a piece of machinery, something that you can physically see that you actually own, and that is obviously generating an income through its use.
Yeah. Basically, I'll give you a little bit of a definition of an asset, which you need to take it little piece by piece. It is an economic, it's a resource. Asset is always a resource, something which is useful for you, right? It's a resource and it is controlled by the entity. Remember the word I'm talking? Controlled by the entity, right? And it came due to a past activity. Maybe you bought it or maybe someone gave it to you. It came due to a past activity and it will give you future economic benefits. So any asset must fall into those four, the definition, the four. One, it's a resource. Second one, it is controlled by the entity. Third one, it came due to some past activity, either you bought or something like that, and it is going to bring you future economic benefits. If any one of those four things are not there, it is no longer an asset. If it is not a resource, it's not an asset. It must be controlled by the entity. The definition does not say that we have to own assets. That is why we have leasehold assets in our balance sheet, in our statement of financial position. You don't need to own, but you should be able to control. What do you mean by control? You can, shift it anywhere, do anything, whatever you want it. And it came due to some past activity. It did not just fall out of the sky. You had to buy it or something happened, and that's how it came. You constructed or something like that. And it is going to bring you future economic benefits. The day that it cannot bring future economic benefits, it's no longer an asset. That's why receivables, we show it an asset. Immediately once it becomes bad, when the customer, the other side of the customer is bankrupt or something like that, it's not going to bring future economic benefits. You have to write off the asset. Similarly, when asset is obsolete, it is not going to bring future economic benefits. You have to write off, because the definition of the asset is a resource. It is controlled by the entity and it came due to a past event and it has a future economic benefit. And this is the very reason, even though most of our CEOs, the directors call the human resource is a very valuable asset, it is not reflected in our statement of financial position. Everyone says the most valuable asset is the human resource, but it is not in the statement of financial position. Why? Out of those four, what is not there? Human resource. It's a resource, surely. It's a resource. It can be controlled. That's the question. Human resource can be controlled. Can we ask the person to stand and wait till he finishes work? Can we ask the person you can't leave the company? Can we ask the person, you have to just wait there where you are installed? Machines, it will, isn't it? Machine, wherever it is installed, it will stay there. But human beings, you can't. So you can't control. That is the only reason that they cannot bring it into our financial statement as an asset. So this has been widely argued, debated in ACCA, in CIMA circles. Still, they have not been able to find a good definition to bring the asset human resource into our statement of financial position. So, you lose a key employee, you have lost a big asset. Even though the asset is not reflected in the balance sheet, the machine that the key employee was operating will have to be subject to impairment. So impairment always is the recoverable amount. Recoverable amount is the greater value of less cost of sale, the value in use. Fair value is less cost to sale, value in use, the present value of future cash from the asset. The moment you have impairment, it must be recorded. The specific asset, we have to charge it to the P&L and remove it from the thing. That's what we have to do with impairment. So this is all about IAS 36. Goodwill is one asset. We need to test it for impairment on an annual basis. Impairment will be necessary, as I said, due to internal things, due to external things like the market value change, technological, physical damage, plans to dispose assets, all that kind of thing. As I said, wherever there is impairment, we can reverse the impairment, but we cannot exceed the amount if there was no impairment or loss. So impairment recognized in a prior period. So we have recognized, shall we say, 10 million. And now we believe there is no impairment, asset is now having the value. Up to 10 million we can write up. Again, the revised carrying amount cannot exceed the amount if there was no impairment loss. Only what we have written earlier can be written back. You can't do more than that much. Agree?
Yeah.
That is what we have to look at on the reverse. These are some other areas SEC examiner has been asked. So whenever there is thing, we have to disclose the amount of impairment loss, reversal of impairment losses recognized directly, amount of reversal in that month. So these are the things, and with that we have finished up one big area. Now what I want to do is I just want to go into the next area, which I'm thinking is on IAS 37, provisions, contingent liabilities and contingent assets. It's another very important standard for us. A lot of questions in this particular area. It's about the provisions, contingent assets and contingent liabilities. So let's look at some of these things just now. So first of all, what is a provision? Oh, before we are going to a provision, just as we described Fiona the asset, what is a liability? Now you remember asset, what is it? It's a resource controlled by the entity, right? It came due to some past event and it is going to bring you future inflows, future economic benefit. That is what an asset is. Now my question is, what is a liability?
A liability is it's an obligation to make payments.
Very good. Yes.
It's a liability is owed by the business.
Yeah, liability. You used a beautiful word. What are that word that you use? It's an obligation.
Yeah.
It's an obligation. Yeah. That's the key important word what we need to remember, right? So it's a basically a obligation is something, a present obligation. Present obligation as a result of a previous event or a past event. You are taking tuition from me and you have a present obligation to pay because you have entered into a contract to buy tuition from me. You buy some goods from particular supplier. You have the moment he supplies goods, you ordered goods and there is a present obligation to pay that part. You went and got a bank loan, signed an agreement with the bank and got a loan. So due to a past event, now there's a present obligation. It's not only a present obligation, it has to be paid in the future. So there's a probable economic outflow of resources in the future. Just like for the asset, there's a probable economic inflow for a liability, there is a probable economic outflow in the future. That is what we call a liability. So remember, present obligation, it came due to a past event, and there's a probable economic outflow for the future. If your husband gives a gift, you don't have obligation to pay it back because there's no probable economic outflow, so you don't need to show. Unfortunately, if he gives you a loan and says, hey, if you have to pay me, then you have to show it as a liability.
Yeah.
That is what a liability. Now, what is the difference between liability and a provision? What's the difference between,
a liability is an obligation to pay, so you definitely need to pay it, whereas a provision is it's not definite, it's an allowance that may be paid.
Yeah, provision is something like this. Let me put it like this. Provision also you have to pay, but you are not exactly sure of the amount and you are not exactly sure of the timing. Now, liability means, in 2 months' time you have to pay for your supply. And he has sent an invoice, you have to pay £20,000 in 2 months' time. That's a liability. Right? Provision, it's a present obligation. Only thing what you do not know is the exact amount to be paid, and you do not know the exact time. Is it clear?
Yeah.
That's what a provision is. So you have to just put that down. A provision is a liability of uncertain amount and or timing. Uncertain amount. But even though it is uncertain, still it can be reliably measured. I mean, it has to be something like 20,000. It may be 20,100. You don't know that whether it's exactly 20,100. But you can't make a provision if you don't know the amount to the very closest or the nearest. You can't say, I have to make a provision. I don't know whether it's 20,000 or 50,000 or 100,000. No, that's not right. You can't make a provision. Provision is for an amount that is surely not known. The timing is not yet known, but you know to some extent it's reasonably measured. So liability, as I said, it's a present obligation arising from past event. Provision is a liability with an uncertain amount of timing. To recognize a provision should be recognized when these conditions are met. It has a present obligation. The present obligation can be legal or constructive as a result of a past event. Right? Now, it's something like this. Let me put it like this. In your company that you are working, one of your employees have gone to the labor tribunal over a kind of a dismissal. Your lawyers say you have wrongly dismissed him and you have to pay. So we know there will be a present obligation arising, but we don't know the amount, exact amount. Lawyer might say you may have to pay 10,000. If he knows that kind of a thing, it's all right. Now that can be what we call a legal obligation. It arises due to the law. What is a constructive obligation? What's a constructive obligation? Constructive obligation is not something arising due to the law, but it is due to your past practices. Right? In your company, for example, whenever a person gets injured while working in office, the past practice had been always to take him to the hospital, and whatever the hospital pays, the company pays. Now, the law does not say so, but you have on past, you have practiced that one. And today, if you meet with an accident, that precedent will apply. This is why we have to be very careful when we create precedents. So in your in the CIMA case study this time, there was a question. They were paying some bonuses for some early completion of films. The question was, they could not complete the film. It was a film industry. They could not complete the film in time. But what happened was, they could not complete not because of the fault of the employees, but fault of the company management. But the question came, should we pay them a bonus even though they have not completed the film? So this can be even a ACCA question. Should we pay them a bonus We have been paying in the past for early completion of film. Should we pay them a bonus even though this film was not completed early? Should we pay them a bonus? Now, what do you think? Should we pay or should not we pay?
Well, no, it depends on the terms of the agreement, but I would say no.
There was no agreement. There was no agreement because the problem is, the agreement was if you complete the film, you pay. But the film could not be completed not due to the fault of the employees, to the fault of the manager. To the fault of the management. Because of the fault of the management, they could not complete the film. Now the question is, should we pay a bonus?
No, because it wasn't completed. It was outside of their control.
Yeah, it was outside their control, exactly, yes. Why are we paying a bonus? Yeah, yes, okay.
Oh, sorry, I'm going to just quickly move rooms.
Okay, I will be there, don't worry. Right, okay.
Sorry, hopefully I'll just be a couple of minutes. I'm just going to move the laptop.
Sure, don't worry. I will be there.
Okay. All right. I'll be back with you shortly. I'm just
don't
moving rooms.
Right, okay.
Okay, yeah, I'm ready to carry on now.
Right, okay. So we were talking about what is a constructive obligation. Constructive obligation is something that is not arising due to the legal nature, but it is due to our past practices or internal procedures. Right? Legally, there's always the law says you have to pay taxes. It's a legal obligation, right? Legally, they say you have to pay gratuity or whatever. That is a legal obligation. Constructive obligation is not something legal, but it is your past practices. So I was talking about that particular case. If you pay a bonus now, why are we paying a bonus? Because for early completion of a film. Whether it's their control or our control, ultimately the film could not be completed on due time. And if you now pay a bonus when they have not completed, you are creating a precedent. And after that, even when the films are not completed, this will be a kind of a precedent and there will be a constructive obligation.
Yeah, so the answer was no. It shouldn't be paid.
Answer is no, definitely. You might be thinking in a practical term because you want to maintain the goodwill. You will not pay the full bonus, but you might pay a very nominal sum in appreciation of what they have done and a kind of a thing. That's a sensible way to look at a question like that.
Yeah.
ACC always their questions itself is a case study. CIMA, specifically there's a paper for a case study. Others generally normally short questions. But ACC, every question is a case study. So you have to be very mindful whenever we answer to give a kind of a balanced, practical answer. ACC. So, provision, there's a probable outflow will be required to settle the obligation. Probable means there's a more than 50% chance that it will be paid.
Yeah.
If the lawyer says that there is, yes, Fiona, but the chances of paying is just about 20%, then it will not fall into the category of a probable outflow. Probable means it should be more than 50% chance of paying. We do not know, but there's a more than 50% chance we have to pay something. And a reliable estimate can be made. Even though we do not know the exact amount, if you know the exact amount, it's a liability. When we don't know the exact amount, even if we can make a reliable estimate, then IAS 37 says you must make a provision. So provision need to be made for present obligations. You don't know the timing, but you don't know the exact amount, but you can make a kind of a reliable estimate, and there's always a probability of more than 50% that you will have to pay the money. In that scenario, you will create a provision. If all these conditions are met, this is what is is important. The three conditions in yellow need to be made to make a provision.
Okay.
What is the obligations? As I said, obligations can be legal or constructive. Legal obligation arises from a contract. You have signed a contract with your landlord. There is a legal obligation to pay the rent, right? Legislation, the tax act HMRC says you have to pay taxes when you earn amount a certain amount. There's a legal obligation to pay. There are other laws like various things, annual revenue license, insurance, all that kind of a thing. You have legal laws which provides we have to pay certain things, and then you have to pay property taxes, etc., all coming from other operational law. Construction is basically the established patterns of the practices, the past practices, and sometimes it is very published statements like saying, the company bears up all the medical expenses of all the employees or whatever. And whenever there's a statement or a policy kind of a thing, that is what we call a constructive obligation. Probable economic outflow means it has to be more likely than not. More likely than not means more than 50% chance of being paid. There may be situations, there is a particular class, for example, you might find 10 employees have gone and filed action against your company, and there is one probable, number one person, there is a 60% probability, second person 30% probability, fourth person 20% probability. You have to calculate all the probabilities, the aggregate of probabilities, and see if it is more than 50. Just because one is 60%, if all the others are below 60, below 50, you don't need to provide it. You have to look at the aggregate and then across the entire class and then provide for your obligation. So IS 37 very, very clearly says where a reliable estimate cannot be made. In other words, it says normally you can make a reliable estimate. Where you cannot make a reliable estimate is it should be the best estimate of likely outflow. It should be a prudent estimate. You remember we discussed the term prudent. We accountants are very conservative. We always look at the worst scenario. We don't look at the best one. So prudent means we look at the worst payment that we need to make and we make the payment. We provide for that kind of thing. Discounted when time value of money is material. Sometimes it is not payable today, it is payable in 3 years' time. In that case, you have to bring it to the present value. But if it is 2 months, 3 months, don't discount it because time value of money won't change on a monthly basis. At least if it is 1, 2, 3 years, then of course you bring it because the 37 says when the time value of money is material. So I think I remember there was a question in ACCA some time back where they said it's 3 months or 6 months kind of a thing. And of course, to mislead the student, they gave the discounting table and all that. And, we foolishly went and applied the discounting table. Because time value is immaterial for 1 month, 2 months, 3 months kind of a thing. It must be more than 1 year, 2 years, 3 years in that case. Sometimes even if it is 2 years, 3 years, if the examiner says the time value is not material, then forget about applying the discount. IS 37 gives very specific applications where provisions cannot be made. One is future operating losses. Now today we are on the February 3rd. You might find that your operation, what we are doing, is going to end up with a loss in March or in May. Now that you can't make a provision today and show that as a loss because it is not yet a loss. So there is not yet a present obligation. You understand? Because there is no present obligation. Present obligation arises due to a past event. So far it has not happened. So far, therefore you don't need to provide for future operating losses. Future operating losses. So this is also another question that came up in last paper, I think, about the future operating. Future operating losses, no reason because there is no present obligation. It's something happening in the future. In May, you have to provide one, not today. Onerous contract. So what is that? This is a contract the company may decide not to fulfill due to excessive unexpected cost compared to the expected benefit. So this is a kind of a contract with a burden. You have already signed the agreement and you want to do a building to another client. And you might find, after doing it for 6 months, you might find if you try to do this building, you are going to end up with a huge loss for your company, right? Compared to the benefits what you can get, the losses are going to be very huge. This kind of a contract, what we call onerous contract. In that case, if this is the case, provision need to be made for the least net cost. That is the lower cost of fulfilling the contract. Okay, if you want to fulfill the contract, how much have we got to spend? If we try to stop the contract, what is the penalty you have to pay? The lower of the two amount need to be provided. Because you can't just stop the contract and just wait. They will impose a penalty on you. So the penalty may be 30 million, but if you try to do the contract, the loss may be 40 million. Provide the lower of the two. Provide the lower of the two because you will pay the 30 million obviously and forget the contract without doing the contract.
Yeah.
Restructuring. What is restructuring? A company might decide, there are two ways generally the companies can improve. One is what we call continuous improvement, what is the Kaizen model, where you go on doing continuous improvement. Sometimes the company might decide to completely restructure. We are going to shut down these divisions. We are going to dismantle these areas, and it might change the scope of the business. The way that it is done, totally different. Already, all this time you were manufacturing, but now you decide not to manufacture, sell all the machines, everything, and to outsource, buy the product and sell it in the market without manufacturing. So it's a material re-chain that is happening. In that kind of a restructuring, if it materially going to change, then you need to make a provision fully. The entity has a detailed formal plan. The restructuring plan is completely known to everyone and anyone. So it has a detailed formal plan. What do you mean by a formal plan? It is something the board has approved and everyone knows that there is a formal plan of a restructuring happening. And there is a valid expectation in those affected that it will carry out the restructuring program by announcing it. That's another condition. Then provision can be only made for the cost that is associated with the necessary restructuring and not associated with the ongoing activity. So you will have the ongoing activity, you will have the restructured activity. You can only make a provision for the restructured activity. Now what are the provisions that comes up on a restructure in Fiona? Right, your company is going through a major process of restructuring. What kind of a provision? Let's say you have a shipping department and a printing department division, and your company decides to shut down the printing division. Once you do that one, there may be certain people going to be transferred to the shipping division, etc., etc. So they say provision can be only made for the cost that is associated with necessarily by the restructure.
Yes.
So when you restructure, what can happen is there can be redundancy, isn't it?
Yes, the redundancy would...
Yeah, people becoming redundant. Now the printing department people who are getting redundant, we need to make a provision.
Yeah.
Right? Just because we are going to do the restructuring in printing, and if some people have to go because of the shipping, that you can't make a provision.
No, because that's an ongoing cost.
That's ongoing activity. The shutting down activity or the activity that is going through restructuring, that activity the provision can be made. And that can be made only if there's a detailed formal plan. There's a valid expectation by the employees of the people of the printing division, knowing that they will become redundant. It is already started to implement. It is already announced. So in other words, there's constructive action happening. Retraining or location of new staff investment are not allowed. Now you might decide to take some of those printing people and train them on shipping. That's not restructuring cost. That is retaining cost because they are going to be employed in the new division. So that is not restructuring cost, and that cannot be allowed. Now these are very tricky ones in the IS 37. These can be questions in your paper. It's not very easy to get that into your mind unless it's made it very clear. So this is why we need to know these things very sharply, the points that we have to work on.
Yeah, I think there's an exposure draft on this as well, isn't there?
Yeah, there is right at the moment there's something happening, but for the moment what we have is the IS 37, which we can get through. So what is a contingent liability? What's a contingent liability? So there can be a possible obligation, there can be a present obligation. Contingent liability is an obligation that will arise from past events whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events. Good example is a case that is pending in court, the judgment which can be in our favor, which can be in against us. That's a contingent liability, right? It can arise from a past events, but it will be confirmed only by the judgment. When you go and sign a guarantee to another friend of yours, there is always a contingent liability hanging on your head. So long as she is paying, you have no problem. But the day she decides not to pay, for whatever the reason, the bank will give you a greeting call early morning and say, hey Fiona, you signed for the guarantee for your friend Kuma. Kuma is not paying, now it's your time to pay.
Yeah.
That's a contingent liability, something hanging on your head all the time. So that's what we call a contingent liability. Or it's a present obligation. So the first part of the thing is a possible obligation. Right? So far there is no obligation, but there is a possibility of obligation happening. The second one, or a present obligation that arises from past events not recognized because of uncertainty of probable outflow, or the amount is not measured reliably. Remember we said a provision need to be when there is a certainty of more than 50% probability and the amount can be measured reliably. When the amount cannot be measured reliably and we are not very certain of the probable outflow, that will be considered not a provision but a contingent liability. Right? So the contingent liability is not recognized in the financial statement. You don't put a double entry for a contingent liability. For a provision, you put a double entry. Debit expenditure, credit the provision. For a liability, you put a double entry. Debit purchases, credits payables. For taxes, you put a double entry. Debit income tax, credit tax payable. But for contingent liability, that is where the probability is not sure, amount is not sure, or still there is no possible obligation. There's a possible obligation, but we do not know whether there's going to be obligation or not. You don't put a double entry. That is what it is meant by not recognizing. You just disclose it as a note. As a note. You don't even need to disclose it as a note unless the possibility of the outflow is very remote, right? The lawyer says there's no chance, Fiona, that the judge will award a thing. In that case, you may not even have to put a note even. So that's what we call a contingent liability. What is a contingent asset? This is the opposite of a liability. This is again like a probable asset or something like that. This happens simply, it is a kind of from past events that will be confirmed only by the occurrence or non-occurrence of one more uncertain future event, not wholly within the control of the entity. Now, can you think of a contingent asset, Fiona? Something still not asset. You remember asset, what is an asset? Asset is something economic resource that came due to a past event, which is controlled by the entity, and it is going to bring future economic benefit. So here,
it could be something like I was trying to think of an example. So it's a possible asset, isn't it?
It's a possible asset, exactly, a possible asset. Because it's still not within the control of us. I mean, it becomes asset the moment it becomes within our control, but when it is still not within our control, it's a contingent asset. The good example, what I can think of is like an insurance claim.
Oh, okay, yeah. I couldn't think of it.
Yeah, put up an insurance claim, still not finalized. We do not know because these insurance fellows are crazy fellows. They promised everything, but when you put the claim, they will show all the small letters and say why it cannot be paid, all that kind of a thing. So that's a kind of a contingent asset. Uncertain future event. So surely not within the control of the entity. Maybe a case that we have filed against another party. We have filed against another party a case, claiming compensation, claiming defamation, something like that. We don't know whether we will get our money or not because it's not within our control, it's within the control of the judge and the other party. So because of that, we cannot consider, we have to put it as a contingent asset.
Yeah.
Contingent asset again not recognized. No double entry is put. Contingent liabilities, no double entry is put. Contingent asset, no double entry is put. But it will be disclosed as a note if an inflow is considered probable. Contingent liabilities, we will always disclose unless it's a very remote thing. Contingent asset, even we will not disclose it unless it is inflow is considered probable. What is probable? More than 50% chance that we will get some money. Otherwise, don't disclose it. The idea is, not to give false hopes to the shareholders. That's the idea. Not to give false hopes to the shareholders saying that we are going to get so much of money from insurance when we are not sure, just wait. So, whenever we have contingent assets, contingent liabilities, we have to describe it, give the estimate, indication the timing or value, the possibility of any reimbursement for contingent liabilities. For example, you might have a claim from your customer for a defective product. You might have insured that against the insurance. So there is a contingent liability on one side and there is a contingent asset on the other side. So you may have to say that part of it. That's simply the thing what we want to look at on the IAS 37. So IAS 37, as far as the contingent liabilities are concerned, there is a possible scenario, a remote possibility. In that case, just ignore. There's a probable liability. In that case, it is disclosed. Virtually certain, then it is, you recognize it as a kind of an asset. So that's basically about the IAS 37. Very, very important one. Future operating losses, no provision will be made. Onerous contract, cost of fulfilling will have to be done. A provision need to be recognized always considering the present obligations, reliably measured, all that. These are the things I think we need to know about it.
Yeah, definitely. It comes up quite regularly, doesn't it?
It comes up, well, I mean, almost at every exam I have seen a provision question coming up. So these are the areas. I'll send you these slides also for you to go through, and recording also will come to you. And so next week we are having a long, 4 sessions, I think, Tuesday, Wednesday, Thursday, Friday.
Yeah, Tuesday to Friday.
Tuesday to Friday we have. So if you have any thinking, you let me know during the weekend, and then I can work on a plan for you.
Okay. Yeah, I'll. Okay. I think next week it would be good to move on to statement of cash flows,
Okay.
group cash flows, group accounts, and then I think a lot of other things will probably come out of that as
Okay.
well.
Yeah. So we will look at the group areas next week when we start on Tuesday.
Yeah.
Sure.
Yeah, and I'll have a run through the other
Yeah. Standards.
standards as well, because things like employee benefits,
Yeah, IS 19,
pension.
yeah, there are many standards in this whole thing.
Yeah.
But we will try to cover up some of those things whilst doing this other work also.
Yes, okay.
Sure. So I'll meet you on Tuesday. I think we are meeting early. Tuesday, I think we are meeting at something like 9 o'clock, no? No.
Yeah, it was either 9 or 9:30. I think it was 9. Is it 9:30?
I put it at 9. It's all right for me. Whatever your time is all right for me.
Yeah, that would be okay. Yeah.
9 in the morning?
Yeah.
Okay. So we are Tuesday, Wednesday, Thursday, Friday, 9 in the morning.
Yeah. Okay.
Right. Okay, Fiona. Have a great weekend. We'll see you on Tuesday again.
You too. Thank you very much.
Thank you. Have a great day.
Okay.
Bye.
You too. Bye.
Bye.